So today I want to talk about how the UK economy is really one big scam, but in a way you can apply this to any economy around the world, because what I'm going to talk about today really has applied to just about every economy you can think of. So why is the UK economy one big scam? How did we get there? And is there really any way to fix it? So first of all, let's have a look at something on the screen. So let's have a look. So this again is related to the UK, and this is the median annual earnings for full-time employees in the United Kingdom from 1999 to 2024. Now, this was really the easiest way to display the change as a graph. So we're going to be looking at a lot of graphs today. I wanted to go back a bit further, but that's fine. We can see the information that's relevant to show why the UK economy is a big scam. Really a big scam against the majority of people living in the UK, and again this will apply to just about every major economy in the world, I would say, and probably non-major economies. So let's have a look here. So let's go to the beginning. So 1999, which meant I would have been about 12 years old. So I'm nearly coming up to my 40s, but not that long ago in real terms, let's say. I don't think so. I mean, maybe you're a lot younger, maybe you're a lot older, but it doesn't seem that long ago. Not in any tangible sense, and certainly in relation to what I'm going to show you. So the median wage, so this is annually, 17,000, nearly 18,000 pounds. So we will just round it up by a couple of £100, okay? Now if we go to the previous year, to this year, 2024, it was 37, and let's say a half, we'll round it up, £1,000 annually. So in the last 25 years, the salary has effectively trebled, okay? Trebled. And as you can see on this graph, that looks very nice, nicely going up, a few little plateaus here and there, and dipped obviously during the coronavirus pandemic. Okay. So there we go. Now when you think of what your salary goes to, what is the principal thing that your salary goes to? What is the most important life mission, let's say? Raising a family. And what does a family need? It needs a house, it needs a home. So let's have a look at house prices. Okay. So we will go further back than 1999, but I'm just going to go to 1999 now. Okay. So where are we? Quarter 3, quarter 1. Sorry if this is a bit small on the screen, but trust me, I'll put all the links in the description. So if we look at the first quarter of 1999, the average house price was £67,500. Okay, so let's go back and remember 1999, 18,000 rounded up. Really, let's just round it up again. You know, again, we're looking at maybe 3 to 4 times the salary to a house. Okay, so the house is effectively 4 annual salaries in those prices, if you had an average salary. Okay, I'll go across again. Right, so just keep that in mind. Now let's go back to today. So we're 2024, remember, this is 37,500 average salary in the UK. So 2004, we're going to go to quarter 1. 260,000, or let's just round that up as £261,000. So what does that mean as your average salary? So even if I was being generous and rounded up to 40,000 as your average salary, 40, 80, 120, 160, 200, 240, 280. So again, if we just round up the both, I mean, again, it's not, that is 7 times the average salary. Okay, so to put that in another perspective, think of it like this. So it's almost doubled. The house prices, let's say, or the average house has, let's say, doubled. No, it's not quite right. Has gone up 4 times extra an annual salary. Is doubled effectively. So you would basically need 80,000 to retain that sort of equivalence of 25 years ago. Does that sound dramatic? Maybe not, maybe it does. Okay, let's put this in another perspective. So what was the gap between a house in 1999 and your annual 1 year salary? It was effectively, let's say, £50,000, okay? Not an inconsiderable amount of money, but £50,000. What is it now? It's 210 or so thousand pounds. You have to find another £160,000. That is a lot of money. That is an extraordinary increase, okay? So, now that we've got that out of the way, so how did we get here and what is really going on? Okay, so there's another thing I'm just going to show you. It's a graph relating to what's called CPI, Consumer Price Index, and House Price Index. There's also something called, I think, CPIH. Now, this is also goes to the root of why the UK economy is a bit of a scam, really, against its people. If you follow any major news network or follow news in general, or I'm sure it's on X, what is the UK measured on? 2 things, okay? GDP and inflation, okay? Now, GDP is really the health of the economy in value, let's say. Now, people can make all this argument whether that matters, whether it's good for the economy. I'm not really going to get into it, but that's, the main measure you'll see. I want to talk about inflation and specifically CPI. Now, you will only ever see in relation to the cost of living, okay, called the CPI. The CPI is the Consumer Price Index, and a Consumer Price Index is effectively what is considered everyday spending. So food, probably fuel, and all these kinds of things. Now, if we look at this graph, it is pretty consistently a few percent a year, with the exception of just after the coronavirus pandemic, where it went up maybe 5-6%. An important point, this does not include housing. Now, there is a CPIH, which includes housing associated costs, possibly including mortgages, but not housing itself. And this is very deliberate, and we'll go back to why this is very deliberate. It's deliberate to keep people under the assumption that what they earn is in bounds of the cost of living. But it will always look like that if you do not include housing. Now, if you included the £160,000 discrepancy from 1999 to 2024, that CPI or CPIH would be way above. People would be outraged. They would be shouting at their televisions. They would be writing to their MPs. And this, again, is the same across the world. Now, you do often hear people complain about the price of housing, but nobody ever puts it in perspective in the truest sense to what is considered the cost of living, or let's say they never compare it to just, let's say, the last 50 years, but a longer historical trend, which you may have seen on the previous graph. So we're going to go back. We're going to go back again to housing, okay? And this is going to follow a long history of the state of the world economy, because housing has a big part in it. Okay, so let's go back to World War II. So after and during World War II, the world was being shaped, let's say, economically and institutionally. So things like the World Bank, the IMF, many institutions were created to create a post-war, really for the victors of World War II, to set up the economies and the world that they thought their populations or politicians and others would be, how it should be shaped. Okay, maybe to keep the peace, but how they thought it would be shaped. So let's actually look here. So this is again related to the UK. Now, interestingly, if we go back to, I guess it's called pre-decimalisation or pre. So Britain's what I'm talking about, coinage and notes, the pound, sorry, was measured differently, let's say. So decimalisation came in the early 70s, okay? And that's an important point. So this is, so what happened after the Second World War, sorry, a lot of institutions in the United Kingdom were publicly owned, and there was a lot of social housing given to the public to give them an opportunity to raise a family in the post-war world. Now, the quality of this housing might have been dubious. Britain was effectively bankrupt for a long time. However, this is what happened. Okay. Now, an interesting thing happened in the 1970s, early 1970s, and this is where things started to dramatically change. For a long time, the American economy, US dollar, was, let's say, pegged to the gold. So the gold standard, you can look up the gold standard, but effectively gold was an important measure against the US dollar. So what happened? Well, I think it was Nixon, the infamous President Nixon, basically scrapped the gold standard. Other countries didn't use gold standard, they measured their economy against the US dollar. Now, an interesting thing, of course, about gold is finite, okay? There is only so much of it on planet Earth, basically, and the US dollar, therefore, was limited by the gold standard. Another thing that happened around this time is banking after the Second World War was very tightly controlled, and this goes back further before the Second World War to the Wall Street crash and the Depression, and this was to contain the economic system from spiraling out of control with debt and speculation, in a crude sense. Okay, these levers started to come off. One of the reasons was the US economy and the world economy, or the Western economy, was starting to move away from industrialization, so big factories, manufacturing, ships, planes, all this kind of thing, en masse, let's say, to a tertiary economy. So you've got a primary economy, agriculture, which a lot of economies still have a lot of agriculture, but was effectively dominated by manufacturing. Now, Asia became a dominating factor in manufacturing. They could do it cheaper because of wages and so forth. You know, typical exploitation, whatever part of the world it is, you can manufacture cheaper in Asia. The standards are good enough or better. So the West had to move to a tertiary, a third part of an economy, which is primarily services, which include banking and so forth, okay? Which meant a lot of people needed jobs, a lot of people needed to do things, and a lot of people needed to create money for the economy. So this all is wrapped into this is all one huge transformation that starts its process. So the interesting thing with the dollar is, by definition, the dollar is not a finite resource. The bank can print dollars. The bank can do things measured in dollars, where it pumps numerical dollars into the economy. This happened in the UK, quantitative ease, all these kinds of things. It's a very lot to take in here, but you can look it up. So, what starts happening? So as you can see, house prices start to go up. Now again, this is part as well of decimalisation. This is, the adjustment of the value of goods in the UK as well. Now, if you remember earlier, I said that the UK economy has had historically a lot of what's called social housing, or housing built for its people. Don't necessarily owned by the country or councils, the local authorities, as a place for people to live in. And around this time, later in the 70s, government started to introduce, basically, you could buy your property. Okay? Now, on the face of this, sounds fantastic. But what happened by the early 80s was the UK economy had a huge contraction in manufacturing and heavy industry and mining and all this. And what they realised is that in this tertiary economy, housing, being what I said earlier, is the biggest spend on your life, let's say. It is the expense of your life. It is a lot of money, even in these terms, in these years. And interestingly, back then, when people did obviously buy their own homes, they didn't have social housing. To get into debt was very difficult, relatively. Getting a mortgage was very difficult. You were not, again, like I was saying about the economy, because of the Wall Street crash, money was not easily borrowed. Okay, and this is very important. But things were technically possible and affordable and relative to your wage. So what happened was realizing that they could gamify the system, and this is governments and others, is sell the social housing to its tenants, which pleased the tenants because it was their opportunity to own a property who would never normally own it. Okay, and what this did is dramatically reduce the physical stock of housing, and the building of new housing came down dramatically. So effectively, you had a lot less housing stock available to the growth of population. So if housing was keeping in line with population, as houses were being sold to social housing be sold, the population did not get new houses weren't being built in relation to social housing. Normal houses were, let's say. So the stock of housing was slowing to the rate of population increase. Now, if you know simple economics, supply and demand. If there's a huge demand, and housing by definition is a necessity, which is another understanding. If you know what housing is, it's a necessity. You can't realistically live without a house. By definition, you can't even open a bank account without a property name, okay? So, to your name. So, the decrease in social housing, the increase in population, supply's gone down, demand's gone up. Very simple principle, an obvious principle. And this has continued for well over really 40 to 50 years now. So as you can see, this, apart from a few dips, which because of recessions, is a natural adjustment. But importantly, these are just tiny dips in relation to the general trend of housing. So you had the 1990 crash, and it was considered a bubble. But actually look at what happened to housing. Prices didn't really, in real sense, compared to where they were not long before, didn't take a huge dip. Then we had the credit crunch in the late 2000s. Again, relatively wasn't a huge dip, quickly recovered. And then we had COVID, where you couldn't sell a house, and here we are now. Okay. So, how does this also feed into the wider economy? So, with the way the economy became structured, and if you go back to what I said about the dollar, and this includes the pound, and this will include the euro, is effectively there is no limit on paper money. There is no limit on digits. Now, you could say, well, what happened to Germany in the 1930s? But of course, Germany in the 1930s had huge financial debts because of war reparations. Really, the debts on modern economies are enormous and huge, but because of this effective formula that has been perfected over the years by Western economies, really it's having low unemployment, low interest rates, high debt, high housing, and what that adds up is effectively a modern day wage slave, really. For most people, it's a very specific thing, which is that you have to service debt. So in the past, where, like I said, very difficult to relatively get into debt. When you earn your money, you earn your money. You might not have much of it left, but you earned it and it was yours. Really, all the money that many households earn now is not their money. That money is owned by the banks for mortgages or for general loans and debt. And this is why debt in the UK and in the US is huge. Public debt and government debt, of course. And all this debt has to be serviced by interest payments. The UK has to pay £100 billion a year just to pay interest, not to bring down the public debt, to pay interest. The population is much the same, where most of the population have effectively got, trillions of pounds of debt. Okay, so this is horrific. So how do they make it technically work? Will wheels come off? Probably in the future, but how do they make it work? So effectively servicing the debt, and by keeping interest rates relatively low. See, this is the other thing. Interest rates are still relatively low, and this is because you can print money, or you can control the mechanisms of the pound on the financial markets, and because of bonds, you can look all this stuff up. But interest rates are the key here in a modern economy, because it's effectively allowing the country to build up debt and to service it. The country basically owns nothing. You probably relatively own nothing, and a mortgage is just that. It's just a debt that you have to pay back, and its interest rates might be relatively low. They've gone higher in recent years, but they might be relatively low, which just means you can earn enough to service it. You might be a wage slave, you might be in permanent indebted, but you'll technically be allowed to occupy that house. You'll have to pay your debts, and this is the point. It's a big scam, because what's happened is, over these years, this graph is really, including public institutions, a huge redistribution of public assets, and of course a lot of public assets were sold off. And do not forget, housing that was social housing is a public asset, was sold off and effectively redistributed as assets into the economy. And of course, therefore, most housing is wrapped up in debt. The reason we had the financial credit crunch is because they realised they couldn't service that debt for a time. But obviously, since then, business as normal. So this is why the economy is a big scam. People do talk about this stuff, but in a way they don't. The CPI is a huge con, a huge sleight of hand that people get very upset about. But if they knew the true figure about inflation, which would include housing, if anybody's sensible enough or wasn't scared enough to print it, would show you a enormous rise in the cost of living. So there you go, and this applies across the world. So I thought I'd just highlight that, because you never really hear people talk about it. So the UK economy is a huge scam. Your economy is probably a huge scam. Put it in the comments below. Tell me what you think. Are you part of this scam? Are you, we all are, right? Anyway, so I'll put all this stuff in the description. You can have a look. Yeah, so there you go. Oh yeah, and is there any way to get out of it? No. It's debt. It's a huge debt. Nobody has the money. It's just eternal servicing. Will they write this debt off one day? They'll probably have to. What will happen to the world? Who knows how it will look? Scary thought, maybe. I don't know. Maybe they'll just keep repackaging the debt like they always do. Anyway, so yeah, there you go. So we'll leave it there. And so you know what to do with the fake YouTube. You can like, comment, subscribe. And I want to give special thanks to my Patreons who support this channel. I want more of you to support it if you could or would like to. You can find that in the description. And those Patreons are Sean, HDX18Nerd, and Soul. So thank you very much, guys. I do appreciate it, and I will see you in the next one.